Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, so $6.12. That was the close on Friday, January 16th. But listen, if you are focusing on the price, you are looking at the absolute least interesting number on the screen. The number you need to burn into your brain is 91.83 million. That's the volume. The volume of shares traded in a single session for BigBear.ai. We are witnessing a liquidity event of massive proportions. If you track the volume-weighted average price, the VWAP, we've climbed from roughly 570 at the start of the year to 620 by mid-month. The market isn't just watching this stock. The market is devouring it.
See, I look at that 91 million shares, and you're right, it's impossible to miss. It's nearly 20% of the float turning over in a day. But I come at it from a completely different angle. You call it devouring, I call it churning. We're seeing the stock stabilize in this, $6 to $6.10 range. It's refusing to break higher despite that massive volume. The question isn't whether shares are trading hands. The question is whether this is sustainable accumulation by smart money or if this is simply the market digesting a massive supply shock. You see a rocket ship feeling up on the launch pad. I see a ceiling forming that's going to leave a lot of retail traders with a headache.
It's not a ceiling, it's a floor. We are witnessing a textbook strategic inflection point. The whole thesis has completely changed as of this week, and the market is scrambling to reprice the asset. The balance sheet is fixed. The distress narrative that has haunted this company for 2 years is dead. And BigBear.ai has positioned itself as a mini Palantir that is finally ready to run without the anchor of bad debt dragging it down.
And that is exactly where I worry people are getting trapped. The strategic inflection is a fantastic story. I get it. It sells great on social media. But the valuation reality is that this company is now trading at nearly 16 times forward sales. 16. That is priced for absolute perfection in a sector, government defense contracting, where execution risk is everything. You don't pay 16 times sales for a company just because they managed to, pay off their credit card. You pay it for hypergrowth that I'm just not sure is fully baked in yet.
Hold on. You're glossing over the financial mechanics of that debt repayment. This isn't just paying off a credit card. Let's actually look at the position statement because the bull case just got a massive injection of adrenaline. On January 14th, the company announced the full conversion of $125 million in 6% senior secured notes,
which dilutes the shareholder base. Let's just be very clear about that. They printed stock to make that problem go away.
They expanded the float, yes. But think about the mechanics here. If they paid that debt in cash, they would blow a quarter of their reserves. Gone. By converting to equity, yes, they dilute you and me. The pie gets sliced a little thinner. But the pie itself is now sitting on $456.6 million in cash as of the last report. They traded short-term dilution for long-term survival. They aren't burning cash to service debt anymore in a high-interest environment. But more importantly, and this is the part the bears are missing, this resets the arbitrage game.
You mean the convertible ARB funds?
Exactly. This is technical, but it's crucial. For years, hedge funds have been running a long debt, short equity trade on BigBear. They held the bonds, which paid a nice coupon, and they shorted the stock to hedge their downside. It created a structural short position, a permanent robotic seller that capped the stock price. With the debt converted, that trade is over. It's dead. Those funds are forced to cover their shorts because the bond is gone. That structural selling pressure is gone, replaced by natural buying pressure. That's why the volume is 90 million. It's the sound of the chains breaking.
I'm not totally convinced by that line of reasoning because it assumes those funds flip immediately to long-term holders. But let's look at my side of the ledger. You brushed past the valuation earlier, but we need to park there for a second. You mentioned 16 times sales. Let's contextualize that. You are paying a massive premium for a company emerging from distress. The Goldilocks assumption here is rampant. The bulls are assuming the integration works, the government contracts keep flowing, and the margins expand immediately.
And why shouldn't they? The demand signal from the DoD is deafening.
Because we have benchmarks for reality. Look at Booz Allen Hamilton. They are the adult in the room in this sector, stable, profitable, dividend paying. They trade at roughly 1.4 times sales. If BigBear.ai fails to prove it is a high-margin, scalable software platform, and the market decides it's actually just a services contractor, essentially a body shop providing data scientists to the Pentagon, the re-rate risk is catastrophic. You could see the multiple collapse from 16 down to 1 or 2. That isn't a correction. That is wealth destruction.
But Booz Allen is a consultancy. They sell hours. Big Bear is a tech platform. That is the fundamental difference, and that brings me to the Ask Sage acquisition. This is the growth engine you're ignoring. They bought Ask Sage for $250 million. This moves them from just providing infrastructure to the application layer, specifically agentic AI.
Agentic AI is the buzzword of the month. What does it actually mean for the bottom line?
It means moving from a chatbot that summarizes text to an agent that takes action. Ask Sage isn't just an LLM wrapper. It's integrated into the secure government cloud. It can read a procurement document, verify the compliance, and draft the response. We're talking about roughly $25 million in annual recurring revenue added immediately. But the key is the margin profile. This isn't consulting hours, this is scalable software revenue. This is why they deserve the tech multiple, not the consultancy multiple.
It's $25 million in ARR, which is nice, I'll grant you that. But does $25 million in revenue justify a $2.7 billion market cap? That's the disconnect. And I want to point out a signal that suggests the mania might be cooling. Look at the implied volatility.
The IV crush?
Yes. Look at the implied volatility, the fear gauge, of the options market. The IV has crashed down to 86.3. The 52-week average is 119. Usually when a stock rips like this, that gauge spikes because everyone is panic buying call options, terrified of missing the move. But here, the IV is crashing. The mania is draining out of the room. It's quiet, too quiet. The fact that IV is dropping suggests the speculative fever is actually breaking, even if the price is holding.
I see why you would think that, but let me give you a different perspective. An IV crush with stable pricing is actually incredibly bullish. It means the volatility is being absorbed. It means the price discovery is happening in a rational way, not a manic one. The volatility is moving from implied to realized, and the stock is holding $6. That tells me the float is moving from weak hands to strong hands. But let's get into the core debate, because the valuation comparison is where the real battle is. You mentioned Booz Allen, but that's the wrong comparison. The market is benchmarking BBAI against Palantir.
Which is dangerous. Extremely dangerous.
It's realistic. Palantir is trading at over 80 times sales. 80. With a market cap around $400 billion. Big Bear is the agile catch-up trade. If Palantir is the operating system for the DoD, Big Bear is the agile, mission-specific application layer. Even if BBAI only re-rates to half of Palantir's multiple, say 40 times sales, you're looking at a double or triple from here. It's the Palantir gap. The market hates a vacuum, and right now there is a massive valuation vacuum between these two stocks.
I'm sorry, but I don't buy that. Palantir has proven profitability. Their U.S. commercial revenue grew 68% last quarter. They are a juggernaut. Comparing BBAI to Palantir is like comparing a local college quarterback to Patrick Mahomes just because they both play football. They are in different leagues. Let's look at a better comparison, C3.ai.
C3.ai is a disaster. Why would you anchor to them?
Because C3.ai is a sobering reality check on what happens when the hype wears off. They trade at about 4 times sales. Why? Because their revenue is projected to shrink by 23% in 2026. BBAI is roughly the same size, 2.7 billion market cap versus 2 billion for C3. But why does Big Bear deserve a 400% premium over C3? That is the question investors need to answer.
Because C3 is shrinking and Big Bear is growing. That's the answer. Investors pay for growth, not contraction. C3 is losing enterprise customers, BBAI is locking in the U.S. Navy 4th Fleet and integrating Ask Sage. You pay up for the strategic inflection, from stability to growth. You don't value a rocket on the launch pad the same way you value a car in the junkyard.
Growth via acquisition is risky. Mergers fail all the time. Cultural clashes, tech integration issues. Ask Sage is a big bite to swallow. And let's talk about who is actually buying this growth. The market structure here is flashing some very strange signals. We have to talk about the short interest and the dark pools.
Absolutely. This is the powder keg mechanics I'm talking about. 24.79% of the float is sold short. That is a massive number. In the Russell 2000, anything over 10% is high. 25% is squeeze territory.
It's crowded, I'll grant you that. But a crowded short trade can stay crowded for a long, long time if the price doesn't force them out.
But they are being forced out. You just can't see it on the lit exchange. Look at the dark pool data. 34.94% of the short volume is happening off exchange. We saw spikes to 46% recently.
Explain that for the listeners who don't spend their day on the terminal. Why does that matter?
It matters because dark pools are where the institutions play hide and seek. If a whale wants to buy 5 million shares, they don't dump that order on the NASDAQ or the NSE because it would spike the price instantly. They go to a private exchange, a dark pool, to match with a seller silently. My interpretation? Market makers are filling institutional buy orders off exchange to keep the price stable while they accumulate inventory. They are suppressing the price to get in, creating the ceiling you talk about, but it's actually a pressure cooker. Once they have their fill, they step aside, and the shorts get blown out.
That's a compelling argument, but have you considered the turnover rate? Roughly 20% of this company changes hands every single day. We're seeing 90 million volume on a float of maybe 450 million. That indicates a battleground, not stable accumulation. If institutions were locking this away in their vaults, volume would dry up. It's not drying up, it's accelerating. That suggests shares are being passed around like hot potatoes.
High volume at a resistance level that turns into support is classic absorption. It's supply meeting demand and demand winning.
Want giants like 2 Sigma stepping in, they increase their position by 165%. Comerica is up 414%. These are algorithmic buyers chasing momentum and volatility signals. Where are the fundamental whales? Where is Vanguard's active fund? Where is Fidelity's growth desk? The smart money right now is purely algorithmic. If the momentum factor turns, those algos sell just as fast as they bought. They don't care about Ask Sage or Agented AI. They care about the slope of the chart.
The fundamental funds wait for the clean quarter. That's coming. But the algos are front-running the catalysts. And speaking of catalysts, we have to look at the macro picture. This stock is correlating with something very specific: geopolitics.
You mean the polymarket correlation?
Exactly. This is the crisis alpha concept. In early January, we saw a direct link. When the polymarket odds for U.S. strikes Iran spiked, BBAI rallied. It acts as a leveraged call option on kinetic conflict. We are entering 2026 with tensions in the Middle East boiling and fears regarding Taiwan escalating. If those prediction markets tick up, BBI outperforms the S&P 500 significantly because it is viewed as a wartime asset.
That is a double-edged sword, though. Look what happened mid-month. The U.S. strikes Iran by Jan 14 contract on polymarket resolved to no. The bettors lost. And what did the stock do? It consolidated. It pulled back. If geopolitical tensions cool, which we all hope they do for humanity's sake, the war premium in this stock evaporates. You're betting on bad news globally to drive good news for your portfolio. That is a fragile thesis.
It's a hedge. Every portfolio needs a hedge against chaos. But the catalysts aren't just war, it's commercial validation. Okay, so you have the war premium with Iran, that's the defense side. But the bull case relies on them being more than just a defense contractor. They need to win in the real world. And that brings us to the New England Patriots.
The Patriots?
Yes, the partnership with the Kraft Group announced on January 9th, optimizing stadium logistics.
I have to push back on this. Does helping people find their seats at Gillette Stadium really justify a defense-grade software valuation? I acknowledge the revenue quality of the U.S. Navy Fourth Fleet partnership. That's real, mission-critical stuff. But sports partnerships feel like press release fluff to me. Does that translate to 70% software margins, or is it just a nice logo for the slide deck?
It proves the technology works in complex, real-time civilian environments. It's the same dual-use thesis that Palantir used to justify its valuation. If you can run a stadium with tens of thousands of variables, people, traffic, security, concessions, you can run a base. If you can run a base, you can run a theater of war. It's all about decision intelligence. It validates the software is agnostic to the problem it solves.
It's a long walk from a football stadium to the Taiwan Strait. But let's look at the technicals, because that's where the rubber meets the road for the next week. The charts don't lie.
The options market is telling us something very specific. There is a heavy flow into debit call spreads, specifically the $557 vertical. Traders are buying the 550s and selling the 7s. The smart money in derivatives is positioning for a grind higher to $7. They aren't betting on a moonshot to 20 right now, but they see clear, profitable upside to 7. They are betting the floor holds.
And yet, the equity analysts are tapping the brakes. Cantor Fitzgerald just downgraded the stock to neutral in January. Their price target? $6. We are trading at $6.12. They are saying the stock is fully valued right here.
Analysts are lagging indicators. They downgraded it after the run. They are covering their backsides.
Or they are looking at the valuation ceiling. The consensus on Wall Street is very tight between 633 and 667. We are bumping our heads against that ceiling right now. The debate is whether the squeeze mechanics you mentioned, the dark pools, the short interest, can actually break through that consensus.
With 25% of the float short at $500 million in cash on the balance sheet, I think the ceiling is made of glass.
Or concrete. If the stock fails to hold $6, there is a lot of air underneath.
Which brings us to the bottom line. The bear thesis of insolvency is dead. It died on January 14th. We have $456 million in cash. We have a massive valuation gap versus Palantir, trading at a discount of nearly 80% on a multiple basis. We have a 25% short interest that is trapped. The stock is coiled. If we clear 650, we are looking at a blue sky breakout.
I remain cautious. At 16 times sales, BigBear.ai has to execute perfectly on the Ask Sage integration. There is no room for error. The high turnover rate and the lack of long-term fundamental holders, the Vanguards and Fidelities, tells me this is still a trader's playground, not an investor's fortress. The volatility will remain extreme. I'm watching the $6 support level. If that breaks, the premium collapses, and we go back to trading on fundamentals, which are much, much lower.
And I say the fundamentals have shifted permanently. It's a cleaner asset, a stronger balance sheet, and a more dangerous world. That is a recipe for upside.
A high-risk, high-reward instrument for 2026. On that, we...
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!